Financial planning and security can sometimes be seen as a moving target. The rules change constantly, and you need guidance to stay ahead of the market moves. This is the Lebenthal Report with industry veterans Michael Hartzman and Dominick Tavella. We'll break down the news, trends, and overall direction of the markets, telling you what may be coming next, investment opportunities, and what to avoid. Now, here are your hosts, Dominick Tavella and Michael Hartzman.
All right, I'm Michael Hartzman. Today is Tuesday, June 18th, 2024, and I'm on as always with my partner, Dominick Tavella. Dom, it's been a minute since we heard that music. How are you?
It's been a while, Mike, and I would argue, at least on my side, I kind of missed it a little bit. So I'm happy I'm able. My fault, I think, for most of my travel schedule, Mike. But happy to be back on board with you, and we have a lot to talk about. So this is a good timing on getting back and doing this again live.
Good. It's all good. We were both out of the country for a couple of weeks, and then life in general. But it's always good timing when we do these shows, especially when we have a global strategist on like we do tonight from JP Morgan. But let me just do a quick rundown of the numbers using my cheat sheet as always from JP Morgan. So as of last Friday, Dom, the S&P was up about 14.5%. The NASDAQ was up about 18.25%, and the Dow Jones was trailing the pack only up about 3.3%. And over a 1 year period, the S&P is up 26, the NASDAQ is up 30, and the Dow is up almost 16. And I know I've said it before, Dom, but this just feels like a very stealthy or clandestine bull market. Every other day, it seems like we hear the S&P has hit a new high. And I say to myself, just doesn't feel like it. Does it feel like it to you?
It not only does it not feel like it, Mike, the truth, the reality, I think, tells a different story. And if I'm going to give you one more to your cheat sheet, the equal weighted S&P 500. And we've talked about this many times before, the market weighted, where you have these very large companies, the Apples, the Nvidias, the Microsoft, and then the rest of the S&P 500. Mike, the equal weighted S&P 500 year to date is up a whopping, shocking 4.7%. 4.7, Mike.
And under normal circumstances, you would take that 4.7. But, it's so lopsided because of the technology sector. And what's really interesting is a couple of weeks ago, Dom, the energy sector was sandwiched between technology and communication services in the. And I was looking at it before the show. It's now fourth from the bottom. Now it's up 6.1%. No one's going to argue 6.1% in half a year, but it went from really being a leader to really dropping way down on the leaderboard. And to your point, technology is up 30%, communication services is up 24%, the S&P is up 14%, and it just drops kind of precipitously.
Yeah, Mike, we look at the broader markets, and we just talked about the S&P, where these large tech stocks are weighted equally, and you realize, the market's had a nice year, 4, almost 5% through the midpoint. That's not a bad return, but it's not the spectacular return that the regular S&P that people watch on TV or the NASDAQ. And certainly when you look at something like energy, energy's probably given up, 10% of the year's gains, Mike? Look at what's going on with the banking sector. Look at small caps and mid caps. It's been I don't want to use the word rough year, but maybe not as ecstatic, as wonderful as some of the major indices pretend that it's been. And so we have to be careful here, and we got to be resolute in our approach. But it's not quite the glory days that some of the headlines make it look like.
We saw this movie before, because this is exactly how the first half of last year went. So, I'm sure you recall, we had a great part of, right? Because we took a little heat because we really didn't participate in the market in the first half of the year because we felt if 493 out of the 500 members of the S&P were just hobbling along, was that really a bull market? And I think it's a little better now, but to me, it is kind of deja vu all over again. Where, as to your point, the equal weighted members of the S&P 500 just aren't having the robust year that I'm not going to call them the Magnificent Seven. I hate that expression.
Well, we're down to four, Mike, and maybe five, but really it's four stocks. They're carrying 80% of the gains in the S&P 500. And look, we can argue that an Nvidia is well deserved. Its earnings and growth has been just nothing short of spectacular. But then when we start getting into some of the other big names, the Microsofts, the Googles, even Apple now has finally seemed like it's turned around, being negative for most of the year. It's finally positive. But it's all on this AI, artificial intelligence myth train, that it's going to be something powerful someday, and people are buying into the hype.
Yeah, and I think I heard you use the word myth. I think a lot of people would disagree with that word, and I think that's what's causing the strength in that sector.
Yeah, Mike, and I obviously use that word intentionally. And I would love to discuss / argue that point with somebody. I think, and I've said this very much and been very out loud, Mike, I think AI will change the world as we know it. I think we'll look at the picture 10 and 20 years from now, and the world as we know it will not be recognizable as it is today. But I just think there's a process to getting there. And maybe, Mike, and that's the myth part, maybe a little of the cart in front of the horse at this stage of the game.
Well, Dom, look, it's clear, just like when people forget, before Facebook, there was a company called MySpace, which basically vanished. And that was the first social network as far as I know. And then you look at the cryptocurrency from a couple of years ago, and all we kept hearing was, crypto's here to stay. We're not sure about Bitcoin in particular. So there's always winners and losers. And I think the slippery slope now, Dom, is I think AI is here to stay. And I don't particularly know if we know all the winners and losers yet. I mean, it's clear at the moment NVIDIA is a market leader, but we don't know how this is going to shake out. To your point, 4 or 5 years from now, I don't think NVIDIA is going anywhere, but how many other companies and which other companies are they going to drag along with them?
And Mike, neither you or I are stock analysts, right? So I don't want to get into the individual names. But today, McDonald's announced they were shutting down their entire AI centric systems that take orders when you go through the drive-through. And I will argue that someday that will be a foundational piece of how McDonald's runs its business. But today, it just doesn't work the way they're supposed to. And therefore, McDonald's had to shut it down until they could figure out how to get the kinks out of it. And that's really my point, that I'm not saying AI is not going to revolutionize the world. I think it will. I just think it's going to take time. And maybe some of the hype has gotten into the system right now.
Absolutely. Well, look, that wouldn't be the first time that's happened, right?
Again, Mike, you and I have been around long enough. Sorry, we're aging, both of us. But we've seen this movie before. We know how it's going to end.
So tonight's guest is Josh Feuerman from JP Morgan Asset Management. He's a global equity strategist. And, we haven't done a show in a while, and there's been a lot of moving parts. But two things I really want to get into with Josh is, number one, interest rates, and how have we gone from 5 or 6 cuts to 1 or none at this point. And it also appears, by all intent and purposes, that this inevitable recession is now an unlikely recession, perhaps. So, I know you have a couple of questions for Josh teed up, but those are two that the top of my mind, Dom.
Mike, two very, very important points, questions. The picture of where interest rates were going to go and what the Fed was going to do, and the prospects and probability for a recession January 1st compared to today. Those two pictures have dramatically changed. changed, right? And part of that process is, well, the economy didn't go, and we can get into the whys, but more important, now we're seeing many of the big Wall Street firms revise their projections for where the S&P is going to end the year and what's going to happen. So I think we have a really, really fascinating guest tonight. And like I love to say, we're going to pick the smartest people in the room's brains here and try to get some insight into what they're thinking and what we should be thinking about.
And look, some of the smartest people in the room already look, you and I were in a beautiful boardroom at the New York Stock Exchange in the beginning of the year. And we heard an analyst say that the mistake the Fed made was they should have started cutting rates in October of 2023. And you and I looked at each other like, that sounds a little aggressive.
And I'll throw out Mike. And again, I'm not. I'll pick on me, Mike. I won't pick on you. You're way smarter than me. But we've said from the beginning, January of this year, I have no idea where these people are thinking we're going to get 5 or 6 rate cuts, right? And we were in the 2 / maybe 3 camp. I think 2 is still possible, but we'll see how it goes, right? But listen, we listen to these people. We take their opinions. They're way, way smarter than me. But then we'll make our own decisions going forward on how we're going to handle it.
So we will be right back with not only the global equity strategist at JP Morgan Asset Management, but a fellow Brooklyn boy and a fellow Sheepshead Bay boy, Josh Feuerman, in just a few moments. All right, I'm Michael Hartzman, back with my partner Dominick and our guest this evening, Josh Feuerman, global equity strategist at JP Morgan Asset Management, a returning guest. How are you, Josh?
Not too bad. Always great to be together with my Brooklyn friends. So.
Thank you.
Well, welcome aboard, Josh.
And as you know, there's an opportunity for us now that they kicked Joey Chestnut out of the Nathan's hot dog eating contest. So I don't know if you guys read that because he endorsed Impossible Hot Dog, they said he's not allowed to participate this July 4th. So I'm in training for that now.
Well, his record is 70 hot dogs, so you better get busy. 10 minutes. Yeah. Well, we'll stick with the easy stuff and try to figure out what's going on with this economy. How's that?
Okay. Yeah, that's at least that's something I have some idea about. 70 hot dogs, no way.
Exactly. So listen, Dom and I talk about it on the open. We talk about it virtually every week. We get invited to a lot of meetings. We get to be in the room with a lot of really smart people. When we say they're smarter than us, we mean it. And how did all of these really smart, well-educated people get this interest rate cycle so wrong for such a long period of time?
Yeah, I think part of it too is one, we're in uncharted territory, right? So as we was jokingly saying back in the break, back in Brooklyn, we used to say nobody knows nothing about nothing, right? Which is true about life. It's true about the markets, right? Well, history doesn't repeat itself, but it rhymes, right? But we were in a 10-year experiment with interest rates at 0. So the odds of us, history repeating itself, it can't repeat itself because we've never been here historically, right? And I think, we have to separate the market from the forecasters, as the case may be, right? And, the issue with the market, what I've been saying to people, and when I talk about the market, I'll talk about the stock market because that's what I focus on, and the S&P 500 as well. And what I've been saying to people is I didn't like the math, and I don't like the math of the S&P from here because I believe the market's priced for perfection. And the problem is when anything's priced for perfection, if you get less than perfection, the market will be disappointed. Now, the first thing I think the market misinterpreted about the Fed goes back to your comment on the 6 rate cuts. Because back in October, Powell came out and said, I don't think we have to do any more rate hikes. That's all he said. The market interpreted that as ding dong, the witch is dead and we killed the beast of inflation. Remember, the first time the Munchkins sang that song, her pissed off sister showed up and it didn't end well for a lot of the Munchkins as well. What Powell was saying back in October, what he was implying, because he's the Fed speaker, he never says anything, he only implies it. What he was implying is that what matters to the economy isn't nominal Fed funds rates, it's what we call real Fed funds rates. Fed funds rate less inflation. That's what drives the economy. And if you think about it, back in October, Fed funds rates were 5.5%, and inflation was 3.5%. So real Fed funds rates were 2%. That is considered restrictive territory. And all Powell was saying was they believed inflation was on a downward trend. So therefore, if they did nothing, real Fed funds rates would actually start to drop if inflation fell as well. And that's all he was saying, is that he thinks they were in restrictive territory already, so that they weren't going to hike, because as inflation fell, real rates would actually go up. All right, because if inflation was 3.5% and fell to 3%, real Fed funds rates would be 5.5 less 3. That'd be 2.5%. They would actually be more restrictive. So what the Fed was saying, because remember, they were saying 3 rate cuts back then, was they felt inflation was going to fall by 75 basis points, 0.75%, and they were going to do 3 25 basis point cuts, so that at the end of this year, they were going to be at the exact same point they were back in October, which was real Fed funds rates at 2%. That was it. The market interpreted that as we have slain the beast of inflation, and they were going to do 6 rate cuts. And that wasn't true, right? And so you saw this euphoria kick into the market back in October, and you saw this junk rally happen, and you saw the small cap stocks rallying as well. And then the market came to the realization that you're not going to get 6 rate cuts, right? And even the Fed has now come out and said inflation is stickier than they thought. That last 100 basis points, getting inflation from 3% to 2%, may be the most difficult part of it as well. And so now the Fed is saying, 1, maybe 2 hikes. Cuts. Our view is probably 1 cut, and our view is that it probably happens after the election as well. Now, there's a second part, because I said there were 2 things that the market was misinterpreting. The first was when Powell said, I don't have to do any more rate hikes. The second, and the market still hasn't worked its way through this, is I believe the market is trading under the misassumption that we have economically achieved a soft landing already. And you hear that on CNBC all the time. They keep talking about this soft landing. Now, the term soft landing actually has to do with landing a plane, right? We've all been on planes that had soft landings. You've all been on planes that have had hard landings. Have you guys ever been on a plane where they applaud when they they expected a different outcome as well? Well, maybe if I flew Frontier Airlines, I'd be like the Pope and I'd kiss the ground every time I got off the plane, right? But I'm on a plane every week, and I will tell you that every plane operates the same, which is 200 miles before you get to the airport. The pilot comes on and said, we've now begun our initial descent into fill in the blank city, and he or she begins to decelerate the plane. They don't fly the plane over the airport and cut the engine, because bad things would happen. It's actually the exact same thing economically. And so an economic soft landing has 3 requirements, and you have to have all 3 of them to say we've got a soft landing. The first and the most difficult one is that inflation has to be at 2%, because that's where the Fed wants it to be. That may be impossible. Realistically, it may be really hard for them to get inflation to 2% without forcing us into a recession. But if they're able to do that, that's the first requirement. The second requirement is GDP growth. The economy still has to be positive as well. And the third is unemployment has to be exactly where it is today, right around 4%. Because the Fed's got a dual mandate. It's keep inflation in check and keep employment high. It is really, really hard. And some would argue the Fed has never gotten a soft landing. But even if they're able to get the soft landing, think about my plane analogy. And Dom, this goes back to the point you were making in the opening. Just like the pilot has to decelerate the plane 200 miles before the airport, a year to a year and a half before the soft landing happens, the Fed has to see it happening, and they have to cut rates. The problem is if you stay higher for longer for too long, which is what the Fed keeps saying, you get a hard landing, aka recession. If you cut too soon, inflation comes back, right? So the Fed has to time its interest rates cut perfectly so it gets all three of those things to happen. But to beat this analogy to death, as Brooklyn guys, you will know this. Remember, like every 5 or 6 years, a plane comes in hot to LaGuardia Airport in January and February, hits the packed ice and slides off into the bay, right? That's what happens economically as well. So if Powell was here, and then I'll promise I'll pause after this, Powell would say they had gotten, in their 110-year history, the Fed has gotten 3 soft landings. They would have told you 1964, 1985, and 1995. But he would tell you 1995 was the only time they stuck the landing, that we didn't slide off the runway. We would say that didn't count because in 1994, they only cut interest rates once by 25 basis points, and unemployment was 6%. So even from here, right, we think that the Fed's going to be slow and steady, but we think odds are, going back to your comments on the recession, we think they're either going to stay higher for too long, which means you get a hard landing, aka recession, or we may get that soft landing sometime early next year, but then slide into a recession early next year.
So Josh, let me just jump right on that exact point, right? So I would argue part of the reason why the experts were talking about a 5 or 6 rate cut is that we would be in a recession about this time, and that would give the Fed the green light to go, you know what, we got to cut interest rates now, we got to restart the economy. So why haven't we gone into a recession? And then if I can add a second question to that, what's the probability that still might happen, to your point?
Yep. And if I look back at last year, right, and Michael, to your point as well, there were 2 things we got wrong, right? We got the economy wrong and we got the market wrong. And I will take the mea culpa on the economy. I will not take the hit on the market. And the reason why I say that is, in the rearview mirror, we should have realized, with $2.5 trillion of excess savings that the federal government pumped into the economy, there was no way we're going into a recession that last year, right? We are a nation of spenders. 2/3 of our economy is consumption, is spending, right? And just like my kids, who are price insensitive because they're spending on my credit card, right? It's the same thing with the economy. If you give people excess money, they're gonna spend it. So realistically, looking backwards, we were premature to say that we should have gotten a recession last year. We've now run out of excess savings, right? Now it's the market, though. To your point about the cap weighted and equal weighted, I will not take the mea culpa on the market, because if we go back 3 years, over 80% of your return in the S&P is just from the price multiple expanding. There's been very little earnings growth over the last 3 years. And it's no one at the start of any calendar year, if I would say to you, look, there's going to be no earnings growth this year, you would assume the market would do nothing. No one's going to say, oh, we're going to get 3 PE points of price multiple expansion, so you're going to go up 20%. So that's why, Dom, I do think that between us running out of excess savings and the Fed's history of never getting a soft landing and never sticking it, I think we probably slide into a mild recession, either late, probably most likely early next year as well. But we do think it will be a mild one, and we could talk about what that means for the market as well.
So why don't we do this? Rather than going to another topic, we're a little ahead of schedule. Why don't we take a break now, Josh, and then we come back. We can finish up that point about, a quick recession or a long recession, and then we could talk about the market in particular and get your thoughts on what Dominick and I talked about on the open. These 5 stocks, 4 stocks, 7 stocks, who cares? How real and how sustainable is that, for the rest of the year, dragging along the rest of the S&P 500?
Perfect.
So we have a lot to talk about when we come back, and we'll be right back with Josh Feuerman from JP Morgan Asset Management. All right, I'm Michael Hartzman, back with my partner Dominick Tavella, and our guest this evening, Josh Feuerman, Global Equity Strategist from JP Morgan Asset Management. And Josh, I have to tell you, we have to have you on more often, because you compared the stock market to the Wicked Witch of the West and Munchkins.
It's a favorite movie of mine. Who doesn't like The Wizard of Oz as well?
Classic.
So my hat's off to you. And just to quote another American favorite, I often quote Yogi Berra, and this market is deja vu all over again. And as I said on the open, it looks like we've seen this movie before with these, again, 5, 6, 7, I don't care, stocks dragging along the rest of the market. So my question for you as a stock guy, Josh, how sustainable is it? How nervous does it make you? And what should we be thinking about hitting a new high every other day?
Yep. And so as I was saying at the open, I don't like the math of the S&P 500 from here for the rest of the year, at least, because I believe the market's priced for perfection. And I told you the two things that I thought. The first, the market worked its way through, and we saw a sell-off earlier this year when the market realized you weren't going to get 6 rate cuts. The thing the market still has to work its way through is that soft landing that we talked about as well. But even if we get this soft landing, and even if the Fed sticks the landing, there are a lot of ifs in there, it's already priced all the way into the market. And I'll show you that. And I apologize in advance because it's going to involve a little bit of math, but I think it's important because it's important to set return expectations as well. So I sit in our Park Avenue office with our analysts at JP Morgan. We've got 40 analysts. They average over 20 years of experience in their sectors. They are experts on these companies. These analysts produce no external research because our clients who use our mutual funds or ETF or institutional or SMAs are paying for their insights. So our clients don't want these analysts giving it away for free on CNBC. So I'm going to take the insight from our experts for the 500 companies in the S&P, and I'm going to add all 500 estimates together to get a bottoms-up forecast of where we think earnings are going in the future. Why do we care? Because the market follows earnings. If the earnings grow, the market tends to go up. And if the earnings contract, the market tends to go down. So I'm going to share my screen with you and hopefully, and so you can see this now, hopefully. Now, you'll notice over on the left, I'm going to get out see if I can get my magic pencil out. You notice on the left here, there's a gray bar and a purple bar. The gray bar is all 500 of our estimates added together on January 1st of that calendar year. And the purple bar is what the S&P actually went on to earn. And you'll notice that this process works pretty well. We're pretty good at forecasting future returns. Now, we're going to start with this 0. And this is actually what I think it was, Michael, that you had alluded to. There was no earnings growth last year in the market. The Magnificent Seven had 7% earnings growth. The other 493 names had a 4% earnings contraction. So had it not been for the Magnificent Seven, earnings would have contracted last year. Ancient history, right? We're at 11% for this year. So the S&P earned 220 last year, and we're at 244 for this year. Dom, to your point, half of the earnings growth is coming from technology. So we actually believe technology had its earnings recession in 2022, and that was part of the sell-off that you saw. So in a weird kind of way, if things turn bad, technology may be a recessionary safe haven. To your point, it's not all of the Fab 4, I think we're up to now, or the Mag 7, right? But you got to pick and choose, but technology may be a safe haven. I'm concerned about 244 for this year, because we're halfway through the year already, and the economy is still growing strong. We're at 281 for next year. That's for 2025, another 15% earnings growth. That's the number I'm skeptical about, because remember, that requires not only all of the boats to be rowing in the same direction, the Fed has to get their soft landing, and they have to stick the landing as well. Because if we slide into a mild recession, you're not going to get to 281. To be brutally honest, I don't think we're going to get to 281 because it conflicts with the Fed's goal of 2% inflation. And the reason why I say that is where a lot of the inflation is coming today is from what we call supply side inflation. It's companies passing on inflation to their customers, right? Either through price increases or what we call shrinkflation. So even double stuffed Oreos aren't double stuffed anymore. They're 1 1/4 stuffed. Pretty soon you're going to end up with 2 cookies and no stuff, right? But in order for the Fed to get inflation to 2%, S&P profit margins are at historically high levels because companies are able to pass on their wage inflation to us. So in order for the Fed to get inflation to 2%, they may have to put pressure on corporate margins, which means you may not get to 281. But this is the happy side. So we're going to say somehow the Fed is going to pull a rabbit out of its hat, and they're going to get their soft landing, and they're going to stick their soft landing, right? And corporate profit margins are going to stay where they are. And we're going to say 280 is a good forecast for what earnings should be in 2025. Once you have those earnings forecasts, you then have to look at what we call the price multiple of the market. And the reason why this is important, this is a kind of a confusing chart. This is something called the forward PE ratio. And what we do is we take the price of the market and divide it by what the S&P is predicted to earn for the next 12 months. This is one of the tools we use to determine whether or not something is overvalued or undervalued. There's an old expression in the market that you're supposed to buy high and sell low. Everybody thinks that has to do with price. It's not about the price, it's about the valuation, because the price of things go up over time. That's called inflation. And so the way I explain this to people is, look, everybody knows somebody who remembers when candy bars were a nickel, right? And for me, it's my father-in-law. And whenever I tell him whatever I paid for something, he says, oh, you overpaid for it, because he remembers when candy bars were a nickel. And what I have to explain to him, he grew up in Boston. When he was able to buy candy bars for a nickel, he and his brothers used to go to Fenway and sit in the bleachers for a quarter. And so what I said to him is, look, the baseball ticket, a quarter, was 5 times the price of the candy bar, right? And that's, so you have to put the price into relation to something else. Now, a candy bar is now $1.50, which means the bleacher seat at Fenway, if we think about that 5-to-1 ratio, should be $7.50. Well, we know it's not, right? The cheapest seat in the bleachers in Fenway is $30. So if that ratio were to hold, that means the candy bar is $6. So is baseball overvalued or candy bars undervalued? As a Yankees fan, I will tell you Red Sox baseball is definitely overvalued as well. Now, we do the exact same thing with this picture. So what this picture says, if you look on the far right-hand side, you're paying $20.95 for every dollar worth of future earnings for the S&P 500. Why would you ever pay more than $1 for a dollar's worth of earnings? Because when you invest in the market, you have a claim on all future earnings, right? So right now you're paying almost $21 for every dollar of earnings. If you look in the center of the picture, the 30-year average is 16.7. So from a valuation perspective, the market looks very expensive relative to where it's traded historically. Now, to Dom's point and the Magnificent Seven, the nature of the market has changed dramatically over the last 30 years, and it's going to change dramatically over the next 30 years. 30 years ago, technology was about 5% of the S&P 500. Now it's 30%. So using 16.71 as a reference point probably isn't great, right? That's probably too low because the nature of the market has changed. But I can't imagine 21 is the new normal. So 16.7 is too low and 20 is too high. That gives us 17, 18, 19, and 20 to play with. The reason why I want to do this, once we have those numbers, and this is the last chart, we now get to play a game called Choose Your Level of Optimism. And here's how we played the game. Look at the left-hand side, and you'll see those forward PEs. Now, I'd like to focus on the column that says $280. The reason why I want to focus on that column, if you recall, that's our earnings forecast for 2025 under the assumption the Fed's going to pull a rabbit out of its hat and everything's going to work out perfectly. Why do I care? This picture, remember, is the price of the market divided by what it's forecasted to earn 12 months forward. So on December 31st of this year, the denominator in this picture would be right around 280, because that's what the S&P is predicted to earn. Remember, from this picture, 12 months forward. So if the denominator is going to be 280, and you think 20 times earnings is the right multiple, you can see that the market would end this year at 5,500. And I did the math for you on the right-hand side. That means you've got about 2% upside for the rest of this year. Now, to your point, Mike, and then I promise I'll take a breath. I never make a price level call on the market. That's a losing game. If I told you my price target was 5,500, 999 out of 1,000 times I'm wrong. And the one time I get it right, I'm lucky. So look, to end up in the green boxes, perfection's going to happen. If the price multiple goes to 19 times, we end up in the red boxes. If the earnings come in at 270, which would still be pretty good earnings, you end up in the red boxes as well. So this is why I basically tell people, like, I'm an equity strategist who's not thrilled about his asset class because the market's priced for perfection. If we get perfection, you may end up in the green boxes, but in the absence of perfection, you end up in the red boxes as well. I apologize. I know there was a lot of math, but I think it's important for people to get the concept.
Dom?
Sure. Hey, Josh. So I have a couple of questions there, but let me start with maybe what will be an easy one. The consumers, as you brought up, has been holding up the economy, right? But we're really a story of two consumers. The lower end consumer that's living paycheck to paycheck or Social Security check to Social Security check, and they've run out of steam. They don't have any money yet. They've maxed out their credit cards. And the other half, maybe third of the consumers, they still have jobs, they're still making money. The value of their 401ks is higher. The value of their homes is higher. But they seem to be running out of steam, or at least they're getting to be much more cautious about spending money. Where does the consumer go from here?
Yeah, and that's the Fed's dilemma, which is exactly what you said, Don, which is that, I mean, their goal is to keep inflation in check because, the bottom income earners are worse off than they were prior to COVID. For you and for me and for the people on this call, inflation is just a nuisance, right? Your clients may tell you, Dom, do you know how much it cost me to fill up my Q8 this morning? And did you see how expensive the organic salmon is at Whole Foods today? But you know what? They're still filling up the Q8 and buying the organic salmon, right? The Fed's dilemma, here's the math of it, right? 2/3 of our economy is consumption. If you make $100,000 a year or more, 100K puts you in the top 60% of income. That's pretty good. The top 60% of incomes drive 80% of consumption. So laying somebody off at Home Depot or Burger King doesn't help the Fed out. They need higher income earners to stop spending. And realistically, the way we stop spending is when we're fearful we're going to lose our jobs, or if you lose your jobs, right? Truman said a recession is when your neighbor loses his job, and a depression is when you lose your job. That's the Fed, and that's why I'm saying the odds of the Fed getting their soft landing is very small because they need unemployment to go up, specifically for people making more than $100,000 a year, because those are the people driving consumption and those are people driving inflation as well. That's why I just don't think this ends nicely, in terms of this experiment that we've been in as well, which is why I've told you I think the market's priced for perfection, and I'm not really thrilled with the math from here as well.
Josh, just to switch gears for a second, the quickest way for me to frustrate a client, I think Dom is the same position I'm in, is we're going to have many, many more conversations between now and the election about the election. And whoever our clients are rooting for, they frequently take the position, well, if the other guy wins, sell everything. If the other guy wins, the economy's going into the toilet. If the other guy wins, we're all doomed. And Dom and I have also seen this movie in the past, and I'm not asking you to make a political call, but we frequently tell our clients the market really doesn't care. The market knows that these are the two candidates, barring something unforeseen, and the market will make adjustments. But at the end of the day, the market typically does not overreact one way or another to election outcomes. Again, I'm not asking you to make a call, as asking if you have an opinion on where Dominick and I normally land on that.
Yep. And so if you look back historically, you get the same returns for the S&P 500 in election years versus non-election years. The S&P does not care who's going to be in the White House in January of 2025. It hates not knowing. If we look at every election for the last 100 years, between July and October, the volatility in the market increases by 25% between July and October as the rhetoric heats up. So your client should anticipate a lot of volatility in the market between July and October. But at the end of the day, the market doesn't care. And here's why the market doesn't care. And here's why it doesn't really make a difference. We have to remind ourselves and our clients that laws are made in Congress, not the White House. That's the first thing. The second thing, and I know this is going to be shocking to a lot of people, so put your seatbelts on. Do you know politicians lie? They say things just to get elected. I know it's shocking. They seem like the honest people. And we have data going back to the Nixon administration. And if you look at the percentage of campaign promises made on the presidential campaign trail and say what percentage of them make it through Congress unscathed. So the presidential candidate says, I'm going to get this done. And it goes exactly through Congress and comes out exactly as he, unfortunately, said it was. What percentage of White House initiatives do you think actually make it through Congress unscathed? You want to hazard a guess?
Less than 5%.
5 is the exact answer. And the highest percentage ever was 8%. And that was under Reagan, George W., and Clinton. So when people talk about this, I say, look, 90% of the stuff they're saying ain't going to get done, or it's not going to look anything like they said. So don't worry about in terms of your portfolio. Right now, there are things you can do to take advantage of the increasing volatility. So if I look at this picture, for example, this picture is ugly looking, right? So what I'm saying is, look, the math isn't great from here, but I will tell you, I am not a big fan of market timing. I've been in this business for over 35 years. I know you guys have been a little bit longer than I have as well. But of the three of us will tell you, there is absolutely no one who can consistently time the market getting in and out, right? Nobody could do it. So I don't believe in market timing. So what I want to do, given this picture and given the comments about election, is I want to stay invested. I just want to dial down the risk within my equity portfolio. I want to move to things that have what we call a lower beta, which just means lower risk relative to the market. I don't want to change my equity allocation. I just want to move to other things that actually can take advantage of the increasing volatility that we know will be forthcoming due to the election.
So, Josh, maybe exactly on that point, your title includes the word global. Do you want to talk a little bit about the global markets, global economies, and where should that fit in client portfolios?
No, I don't. I will tell you that, international is such a tough conversation because it's been disappointing for so long relative to the U.S. The U.S.
Can I just interrupt you and say thank you for admitting that? But go ahead, please.
Yeah. Well, I spent the first 2 decades of my career managing international portfolios as well. Now, from an international investing perspective, the U.S. has outperformed international by 7% annualized over like the last 15 years. The rule of 7 is your money doubles every decade. You've made twice as much in the U.S. as you have international as well. Now, of that 7%, 2% of it came from the dollar appreciating over the last decade, because if those of you could roll back the clock a decade ago, Europe used to have what was called NERP, negative interest rate policy. The US 10-year was the only game in town. So every foreigner bought the dollar to buy our 10-year bond, and that caused 2% appreciation. We think that 2% headwind will dissipate, but the other 5%, and Dom, this is going to look back into your questions about, sort of AI and technology. Actually, let's see, I think I have the picture here. Sorry. Oh, it's this picture on the left. This picture on the left shows you the PE, that same ratio that I showed you before, for the S&P compared to the rest of the world. And I always point out to people, look where the zero line is. The S&P always trades at a higher PE because we have 30% technology and the rest of the world has 11. When we drove interest rates to zero for a decade, PEs expanded, but you got phenomenal price multiple expansion on the growth side of the equation. And every 6 to 9 months, somebody showed Mike or Dom this picture and said, look how undervalued international is. And all it did was get more and more undervalued for a decade. My hesitation with international is that historically, because you got the sense from the earlier comments, I don't think we're out of the woods in terms of a recession for the US. And when the US falls into recession, we tend to pull the rest of the world with us as well. So it's really hard to make the case for international. And I do want to, in our remaining time, I do want to address your question about the comments you made about artificial intelligence, because I do think that's going to be a game changer, but I also think a vast majority of those companies are going to be US-based. And it's really hard, if you really think AI is going to be a game changer, it's really hard to get excited about international for the long term.
To that point, I do want you to finish up on artificial intelligence. But the other thing that Dominick and I wasted an awful lot of time, Josh, is going to meetings and hearing about the BRICS. Remember that? Brazil, Russia, India, and China. And then magically people stopped talking about that. But so rather than beating that to death, why don't we spend the remaining time talking about either you or JP Morgan's view on AI? I said earlier, they're going to be winners and losers. We have 4 minutes. The floor is yours.
Thank you. So AI, to Dom's point, it is going to change our lives in ways we can't even begin to understand. In his annual letter, Jamie Dimon compared artificial intelligence to the invention of the printing press. And he's 100% correct because he's the boss. He signs the check, right? As we said in Brooklyn, I might be dumb, but I ain't stupid. I'm not going to argue with the boss, right? But what's embedded in that comment, which most people don't think about, is there was a huge time gap between the printing of the first Gutenberg Bible and commercial viability of the printing press as well. And there's going to be the same thing with AI. It's not going to be hundreds of years as it was with the printing press, but there's going to be a gap. We've got a really good technology analyst on our growth platform, a guy by the name of Joe Wilson. And he says this in every call that he does, and I stole this statement from him. He said the true winners from artificial intelligence are companies that haven't even been created yet, right? For those of us old enough to remember when the internet came out, and Mike, you said this as well, right? There was MySpace before Facebook. There was no Amazon, and there was no Google, right? So you know how the movie ends. You just don't know who the winners are going to be. In the last decade, there have been 5,500 AI startups funded by private equity. There are only something like 4,500 publicly traded companies in the United States. Do you think all 5,500 of those are going to see the light of day? Absolutely not. You know how the movie ends, right? Some of them are going to be Pets.com 2.0, and we're going to see some great Super Bowl ads next February, right before they go bankrupt, because that's exactly what happened with Pets.com. Some of them are never going to go public, right? So you need to access them through private equity. Just because you go public doesn't mean you know what you're doing. I did a lunch 2 months ago, and I was walking from our office on Park Avenue to 6th Avenue, and I walked right past the WeWorks headquarters. Right, their name's still on the building, even though they're in bankruptcy. So your opportunity set in AI is what I call this picture. minnows to whales, right? These are 4 whales that we're all familiar with. The yellow line is when they go public on the Russell 2, and look at the yellow line. They don't do anything because you have to demonstrate efficacy. You have to show you know what you're doing. Then you become a small fry on the Russell 1000. That's the green line, and you take off like a rocket. We like Broadcom. We love NVIDIA. We love Google. You're not going to make 5,000% from those from here. So from 3 guys from Brooklyn, I'll use a surfing analogy. I've gone surfing 4 times in my life. I'm horrible at it. You got to start paddling before the wave forms. So Dom, to your point, this is my 5-year call, my 5-year investment. If I had to make a 5-year investment today, I'm buying an active growth solution with a good tech analyst that has the ability to dip into small cap stock, because I need an expert who can figure out which of these minnows could grow into whales. This is your opportunity set. Now, going back to your comment on the concentration of the market today.
Josh, I apologize. We are out of time.
Oh, okay.
I apologize. We have to have you back. This is our.
I was going to say that's the impetus, Mike, to Josh too. So let's see how quickly we can make that happen.
Very quickly, 10 seconds. I know you got to go.
Continue this conversation.
The S&P was equally as concentrated in the late 60s, and it was Kodak and General Electric and General Motors at the top of the order. So, Dom, to your point, I will guarantee the S&P will look very different a decade from now than it does today, just like it looks very different than the late 60s.
Josh, that's an excellent point. We thank you for your time, but we are out of time, folks. And Dominic and I will be back next week with a new edition of the Lebenthal Report. Good night, everybody.